Taking the first steps to investing can feel scary. That's why low-risk investing is popular for beginners. But what is low-risk investing? And are the risks really as low as you think? Searching the internet for answers to this question can be challenging. That's why I've put them all together in this one video. My name is Charlotte Jessup and I am a financial education nerd. Educating you about how your money works is my full-time job. I want you to know how your money works and how you can get it working for you. Hence the Looking After Your Pennies YouTube channel. Now I have to tell you that this video is not financial advice. Investing is risky, so please speak to an FCA registered financial advisor if you want more information about your personal situation. Now let's get into the details of what I'm going to cover in this video. So number one is, what do I mean by investing? Number two is, what can you invest in? Number three is things that you should consider before you start investing. Number four is, should you opt for low risk? And five is, where can you go if you want to learn more? So let's start with, what do I mean by investing? Well, I mean putting your money anywhere where it can be safe, secure it for the long term, but also where it can grow too. Most people invest their money hoping at the end of the day it will actually be worth more than what they put in. There are lots of reasons why you might want to start investing, but for most people they're investing for retirement or for large future purchases. When done right, investing can be a powerful tool to grow your money. But when done badly, you do put yourself at risk of losing money. It's for this reason that people are scared off of investing. They just don't want to risk losing their money. In reality, there are some great low-risk ways that you can invest your money without being too worried about losing it. So what can you invest in? So there are lots of things you can invest in, including cars, handbags, and artwork. But these are much riskier strategies, and it's much harder to predict what might happen to these sorts of investments. There are obviously some more common investing strategies such as property, which lots of people get into, but these typically require large deposits before you can step into that market. Not necessarily the best strategy for beginners. For the purpose of this video, I'm going to share investments that you can get started in with smaller amounts of money. So the first one is high interest savings accounts. Now this is not what most people mean when they think about investing, but it is a way of storing your money fairly safely and hoping it will grow over time. These accounts will earn interest, so if you're looking at this as a way of growing your money, you want to try and get the best interest rate you can. Currently, the interest rates are low, think less than 1%, and for many accounts it's much less. With this option, your money is pretty secure. Most bank accounts are covered by the Financial Services Compensation Scheme, or FSCS, and will protect your money up to £85,000. But this isn't a completely risk-free option. The risk here is that your money could be earning interest at a rate that is lower than the amount of inflation. This means that it's probably losing value or purchasing power. It means that things are getting more expensive at a faster rate than your savings can keep up. And this in itself is a risk. So number two is fixed rate savings accounts. Now, if you've got a lump of cash that you can afford to lock away for 1 to 2+ years, then this might be a good option for you. You will need to lock your money away during this time, and this means it could be hard to access your money and it could take a long time to withdraw it. And there could be penalties for this too. You will likely not gain any of the interest that you were promised, and you could lose some of your initial investment. But if you are able to make this commitment, then banks normally give a higher interest rate on these sorts of savings accounts. The longer you are able to lock your money away, the higher the interest rate normally is. And again, your money is pretty safe. But if you are not getting an interest rate that is going to beat inflation, then again, your money is going to be losing value or purchasing power over time. So number three is premium bonds. So I always think of old people when I think of premium bonds, and that's because I know they were popular with my grandparents. They're also the sort of thing that people gift to children, so you might already have some premium bonds or have had some premium bonds in the past. But a lot of people are still using premium bonds, and for some pretty good reasons. The thing is, there is a £1 million prize up for grabs every month. but the odds of winning this are pretty low. In reality, the average prize rate is about 1%. And this is as close as we get to having a figure that compares to anything like an interest rate. But the reality is that most people who have premium bonds get nothing. This is particularly true if you have less than £10,000 in premium bonds. Premium bonds could probably be thought of less as an investment, but more as a safe place to store your money. They are government backed and they are tax free, so it's not a bad place to store things, say like an emergency fund. But the reality of getting a return or growing your money over time is pretty slim. However, there is still the chance that you could get $1 million or either some other monetary amount in return. But once again, you need to factor in inflation. If you never win anything on your premium bonds, then the chances are that your money is going to be losing value if you are keeping them in premium bonds. So number 4 is corporate bonds and gilts. Corporate bonds and government bonds, sometimes called gilts, are an investing asset that are considered to be low risk. Unlike with stocks and shares where you buy a small piece of a company, with bonds you are loaning your money to that company or to the government and getting an interest paid back on your money. They are considered a less volatile option, and many experienced investors include them as part of their portfolio to act as a stabilizing influence. Generally, the returns on bonds aren't as great as they are with stocks, but they are still likely to return a rate that is beating inflation and possibly earn you a little bit extra on top. Government bonds are considered to be the least risky of the two. In this example, you'll be giving your money to governments, and because governments are considered fairly stable, you're likely to get your money back plus the additional returns. Naturally, there is no guarantees that you will get your money back, but generally they are considered one of the safest investment assets out there. So number 5 is index funds. So here we're stepping up the risk just a little bit. With index funds, you are investing in a group of companies and you will be buying stocks and shares within those companies. An index is a list of different companies that have all been grouped together for some particular reason. An example of this is the S&P 500, which is the top 500 companies on the New York Stock Exchange. Investing in a fund that tracks this index would mean putting some of your money into each of those 500 companies. This is essentially the exact opposite of putting all of your eggs in one basket. By investing into a huge range of companies in this way, you are limiting your exposure to individual losses in certain companies. There are funds that go beyond this and allow you to invest in big companies, small companies, like companies that are based in your country and companies that are based globally, as well as in different industries such as tech or energy, etc. The risk here is slightly greater, but it is still far less risky than just investing into 1 or 2 individual companies. So what things should you consider before you start investing? If you're new to investing, there are a few things you should consider first. The first thing is how much can you actually afford to invest? This would include things like having an emergency fund or having the money in your budget to cover these investments. Investing for the long term is one of the best ways that you can limit how much money you are at risk of losing. But if you need to dip into your investments because your washing machine's broken or your kid needs new school shoes, then you're going to reduce the amount of time that you are investing and therefore increasing your risk of losing money. Having an emergency fund in an easy access savings account will mean that you can dip into this instead of into your investments. Paying off any high interest debt is also a wise move before you start investing. If you have a credit card with an APR of 25%, then by paying off this debt, you're essentially getting a 25% return on that money. This sort of return is likely to be better than any of the returns that you'll get in any of the investment strategies that I have mentioned previously in this video. Paying off your debt will give you peace of mind, plus it will help free up some extra cash in the future that you can then choose to put towards your investments. Should you really opt for low risk? Now, risk appetite is obviously very personal. I've met some people that are completely risk averse and others that are willing to stake their last penny on a big win. Therefore, please remember that this is not financial advice and think about your own personal situation. But if you are young, say in your 20s and 30s, then you could perhaps consider going for slightly riskier investments. Now, this is because you have lots of time to invest and to see potential returns on those investments. When you're investing for a long time, any dips in the stock market can be recovered from, and overall you should see growth in your money. Generally, people look to reduce their risk as they get closer to accessing those funds. Essentially, you don't want the stock market to take a big dip right before you take that money out. This is when you stand the potential of losing money. But if you do this over the long term, you should be able to ride out those dips and see those returns that you're looking for. So where can you go to learn more? So I create videos about financial education and investing twice a week. So make sure you hit that subscribe button to get a little nudge every time I post a new video. In addition to this, I run a financial education membership called the Money Nook. Within this membership, you get access to monthly workshops, live Q&As, group coaching, as well as some of my popular courses. One of these is a beginner's guide to investing called Investing Confidence. This offers over 2 hours of videos on things such as how the stock market works, how to make your first investment, and other stuff such as pensions and mindset and risk. For more information about this, visit themoneynook.com or click on the link in the description. Big thank you for watching this video. Don't forget to hit that like button and leave me a comment below. I would love to know where you're at on your financial journey and how you feel about risking your money in investments. I'll be back in a couple of days with another video and I will see you then. Bye!